Hi, I'm Ben from Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. Now, there are various ways of valuing a company before investing on the stock market. These are characterized as both qualitative and quantitative factors. The world's greatest investor, Warren Buffett, uses both of these factors to value a company before investing. So in this video, I'm going to define these methods of analysis and show you how Warren Buffett has used these factors to become the billionaire investor we know today. Let's dive in. Before we get started, go ahead, smash that like button. It really helps us out with the YouTube algorithm, which means we can provide more free content like this to help you. In addition, if you're interested in more investing tips and strategies, be sure to subscribe and turn the notification bell on. That way you'll get notified when we release future investing videos. Let's get into it. So what are quantitative factors? Well, quantitative factors are numerical outcomes of a decision which can be measured. Now, the key there is these are tangible factors which can be measured. This is the numbers side of valuing a business. These quantitative factors can usually be found in the company's financial statements, such as their balance sheet, their cash flow statements, their income statements. That's where you can analyze and find out these quantitative factors. In part 2 of this video, I'm going to run through 4 very important ones which Warren Buffett uses to value companies. But first, what are qualitative factors? Qualitative factors are those factors which cannot be directly measured. Remember, numbers are not the only important thing when valuing a company. They are one part of it, quantitative, the other part is qualitative. So I'm going to run through 10 qualitative factors Warren Buffett uses when valuing a company. Coming in at number 1 is the company's core businesses. You should clearly understand the business's revenue model and how it makes its money. One of Warren Buffett's most famous statements is that he only invests in businesses he can understand. This is very important, as should there be an issue in the business, if you understand its revenue model, you can understand where the issue is. However, if it's a very, very complex business and you don't really understand it, then if there's an issue, you're dead. So understanding the business in a simple way is key. For example, one of Warren Buffett's most famous investments is in Coca-Cola. Now, it's pretty clear how Coca-Cola's revenue model works. They're a soft drinks provider internationally. Another business model which is popular with Buffett is airlines. It's pretty simple how they make their money. He tends to steer clear of certain software companies which he doesn't fully understand the industry. Coming at number 2 is the quality of management. Is the management motivated? Are they experienced? Are they intelligent? And most importantly, do they have integrity? A motivated, experienced and intelligent management team will get the business through tough times. A switched on management team will have a better chance of powering the business through any rough economic conditions. Integrity is also extremely important, and Buffett makes this very clear in many of his books. Integrity is based on honesty, and that is a crucial factor when selecting a management team or selecting a company to invest in with a certain management team. So what you need to look for is, say the company is going through tough times, you want the management to be honest with you. You want the management to be honest to the investors and say, look, we're going through these tough times. This is the issue. We've put these solutions in place and this is what we're going to try and do. That's what you want. You don't want a management team who's going to say, no, it's all fine and not tell you what the real issues are. So that's why integrity is up there as one of the key qualitative factors. To find out more information on this, you can check out the company's website analyze their team, and look for what relevant industry experience their team has. For integrity, you can check out personal references, or if you have insider knowledge, that is really helpful. Other points in this section include checking out the history of management and checking out the MD&A report, the Management Discussion and Analysis report. The MD&A report is a section on the company's annual report or quarterly filing. In this section of the report, the executives analyse the company and its overall performance. They also talk about the risks and future plans for the business. Coming in at number 3 is knowing the company's customer and geographical exposure. This is extremely important as you need to know the business's ideal customer. Are they B2B? Are they B2C? Do they have a few large customers, or do they have many small customers? In the market, are they more high-end, such as Louis Vuitton, or are they more on the budget side, such as Primark? With geographical exposure, you need to analyse where the company operates. You also need to look at if it doesn't operate in a certain territory, ask the question, why not? Do they have plans to expand into future territories? Do they get more sales in a certain territory as opposed to another? If so, why? If a company is more geographically diverse, this often correlates with a less risky investment. As if there is an issue in a certain country, such as the UK, then it still has the US market. Or if there's an issue in the US market, it still has the German market. Adds a layer of diversification and also room for company expansion. Coming in at number 4, what is the company's competitive advantage? Do they have a well-known, established and trustworthy brand? That can be a USP. Do they have an efficient operating structure in which they can churn out more profits than their competitors? Do they have certain patents and protections on technologies? Does the company have a competitive advantage in the area of organisation and strategy? Coming in at number 5 is corporate governance. Does the company's rules align with the company's vision? Is the company serving each stakeholder? Is the company compliant with all rules and regulations? Coming in at number 6 is industry growth trends. You should analyse the industry growth trends over the past 10 years and look at market prediction studies for the future. For example, the electric vehicle industry is increasing in popularity, and that's one of the reasons why Tesla is such a popular stock. It's in my portfolio. Coming in at number 7 is competitive analysis. Competitive analysis is just that. It's analysing the competitors in the market and seeing where you stand. Are you number 1? Are you number 2? Number 8 is disruptive technology. You need to be aware if any disruptive technology could seriously impact your business. For example, Airbnb was a disruptive technology for the hotel industry. It's not completely destroyed it, but it's definitely hit their revenues hard. Uber is another business which is affecting the taxi market. Number 9 is market share. What's the size of the market? What piece of the pie does that company have? Is it a niche market? Is it a general market? Number 10 is regulation and government consensus. Have all the company's products and services been approved by all the regulating bodies? Does the company have good relations with the government? Be sure to check out the income and cash flow statements to see if there are any costly legal disputes. Now, so that's qualitative factors. So what about quantitative factors and quantitative analysis? Well, I did a really detailed video on this, covering 11 financial metrics used by Warren Buffett you should know. But in this video, I'm going to just cover 4 very important ones. And I'm going to tell you specifically what Warren Buffett looks for when analysing these factors. Coming at number 1 is earnings per share. Warren Buffett looks for the earnings per share of the company to have been consistently rising over the past 10 years. The long-term debt should also not be more than 5 times the net profit. Coming at number 2 is return on equity. When Warren Buffett analyses a company, he looks for those with return on equity greater than or equal to 15%. In the example below, which has a £50,000 equity capital and £50,000 debt capital, and from its operations earns £20,000 net profit, if the debt capital was borrowed at 10%, they would need to pay back £5,000 interest. So now there is £15,000 net profit left. So now the equity shareholders' return on equity is 15,000 divided by 50,000 equals 30%. So in this example, the return on equity is 30%. Warren Buffett states this type of return on equity should be greater than or equal to 15%. Number 3 is return on capital employed. This should be greater than or equal to 12% and can be calculated by taking the equity capital plus debt capital minus current liability. And last on the list is free cash flow. Warren Buffett states that free cash flow should be greater than 0. Thus, free cash is always available for investments, for operations, and for dividend payout. If you're interested more on quantitative factors, be sure to check out the more in-depth video I did on 10 financial metrics in 10 minutes, link below. And if you found this video inspiring or informative, go ahead, smash that like button, and definitely subscribe. See you next time.